So the other issue which we touched on, would you invest assets outside of super? Super does have the great tax advantages, but obviously you can't do things like negative gearing. So you can buy a property and use any extra interest that you've paid to be deducted against other income. So there are some advantages in keeping assets outside of super. Certainly, if you're below the age of 65, it's difficult to access a lump sum if you needed it. So, if you wanted to pass money on to your children, you do have to wait until a certain age before you can access money. And then there are some benefits in estate planning outside of super. Now, they're relatively complicated, so I won't go into great detail on them. But, there are some ways that you can pass on assets to children and others, which are easier outside of super. The other point, which I haven't written down because it's an issue some people raise. The government does change the super regulations every so often. They tend to tinker with the rules. The Division 296 thing is one example of that. Keeping some assets outside of super sort of protects you against the government bringing in some rules which may not be that beneficial to you. So, while I encourage people to say, look, use super as a tax advantage savings vehicle, you do want to be cognizant of, all governments have a habit of tinkering with these systems when it suits them. So